Hi, I'm Shannon, Seery, an economist with Wells Fargo, and I'm joined today by my colleague, Michael Pugliese, to discuss the latest changes to our forecast. So Mike, we haven't made significant changes to our forecast since our last annual update in December, but perhaps you could just start off by talking about the latest data.
Yeah, what I would say about our most recent economic outlook is it hasn't changed that much, and the biggest changes have really been from a near-term perspective where the economic outlook has brightened a little bit. The most recent data we've gotten, so for the labor market as an example, it's continued to look very strong, very tight. Unemployment dipped once again and went down to 3.5%. Non-farm payroll growth was very solid at more than 200,000 jobs for the month of December. GDP growth, which was above 3% in the third quarter, looks to be tracking at roughly similar pace in the fourth quarter. So whether you're looking at growth or in the labor market or growth in GDP more broadly, I think we've seen pretty good near-term signs. And some of that has been buoyed by the fact that inflation has finally shown some signs of slowing down, where you've seen headline inflation over the past few months show some signs of cooling, led in a big part by lower energy prices, falling prices for gasoline, but also slower inflation elsewhere. So, in goods categories like used autos, in some pandemic hit sectors, airfares and car rentals and those types of areas, you've also seen some deflation as well. So all these factors have kind of come together in the near term for a little bit more kind of an optimistic near-term picture for the economy. What about from the consumer standpoint, Shannon? When I think about that still pretty strong pace of job growth, that slower pace of inflation, how is it playing out for the consumer right now?
Right, Mike. So I think some of this near-term brightness that you're talking about directly translates into the consumer. So the fact that inflation is starting to subside more meaningfully is directly impacting real disposable income growth, which has been positive for the past 5 months. So that's becoming a tailwind for consumers in terms of their purchasing power. And PCE for the fourth quarter is shaping up to be pretty strong at about a 3% annualized pace. So that definitely translates to some near-term growth, and I think is part of the reason we've adjusted our forecast here in the latest update. So when I think about the broader outlook, yes, there are some near-term positives that are translating to higher growth, but there's also some areas of concern. So the housing market is very much still in contraction, and we're starting to see more weakness show up in the manufacturing sector. So how do you think the Fed is tying all of these things together in terms of the economic outlook and how they're setting monetary policy from this point on?
So when I think about where the Fed is right now on monetary policy, yes, it's been encouraging that we've seen some stronger economic data recently. I think it's been encouraging that the inflation side has directionally shown some progress. But I don't think the Fed views that as mission accomplished. Whether you're looking at the core CPI or the core PCE deflator, inflation is still running above the Fed's 2% inflation target. And furthermore, there's still parts and pockets of the inflation outlook that remain concerning. So, for example, yes, the labor market's very tight, but it's probably still a little bit too tight, as signaled by wage growth that is running 1 to 2 percentage points above what would be consistent with medium to longer run inflation of about 2%. And so when it comes to Fed monetary policy going forward, I still think we've got more rate hikes to go. And our base case is 3 more 25 basis point rate hikes at the next 3 FOMC meetings. So when I think about the economic outlook a little bit further out, later this year into 2024, we're still concerned. We've still got a mild recession in the forecast later this year, as 2 things still bite. First, the past monetary policy tightening that has already occurred, as we feel the lagged effect of that very meaningful amount of policy tightening that happened in 2022. And second, as the Fed's not done yet, whether it's the 3 more 25 basis point rate hikes we're forecasting or its quantitative tightening program, where the Fed is reducing its balance sheet by up to $95 billion a month as securities roll off and kind of reduce those holdings that the central bank has. So you pull all that together, and yes, there's, I think, some encouraging near-term data, whether it's inflation or a labor market that's been resilient or GDP growth that remains positive, but there's still more tightening to come, and as a result, I think we're going to be in a weaker economic environment later this year, and probably one that includes at least a mild recession in the United States.
Well, Mike, thanks for joining us. And from all of us at Wells Fargo, thanks for tuning in to our latest monthly economic outlook.